Welcome to the Power and Market Report. I'm Albert Liu. I'm joined now by Adrian Day. He's the chairman and CEO of Adrian Day Asset Management. He's also the author of Investing Resources, How to Profit from the Outsized Potential and Avoid the Risk. Adrian, thank you for joining me on the Power Market Report. How are you?
Well, I'm fine, thank you, and thank you for having me.
It's my pleasure. And I want to talk about a lot of things tonight, but let's start with the U.S. markets and the Fed's involvement. Last month, we had a rough September, we had a rough August. It was looking like things were going to turn really bad, and then all of a sudden the Fed comes along, says they're going to delay the rate hike, and so far Q4 has been pretty good. I mean, the S&P is up over 5%. We had Microsoft beat earnings today, and they're trading up in the after hours. Amazon also reported and is doing well. Has everything just turned around? I mean, are all of our worries behind us at this point?
Well, I wouldn't go that far. I mean, I think you're quite correct that the market in recent months has been focusing on the Fed, what the Fed's going to do and when it's going to do it. I frankly think that focus is overdone for a lot of reasons. But first of all, I don't think the Fed is going to. We've only got a couple of months left, so my prediction that there'll be one hike this year might be true, or it might not be. But the point is, at most we're going to get 1/4 point hike in the Fed rates. We're probably not going to get any hikes next year because it's an election year, and the Fed doesn't like to, move rates one way or the other too dramatically in an election year. But at any rate, this certainly isn't going to be the start of an aggressive turn in interest rates. And, frankly, going from 1/4% to 0.5%, although it's a 100% move, that's not the important rate hike. It starts to get important when rates start to get to 4, 4.5, 5%. That's when it starts to have a meaningful impact. I mean, going from 1/4 to 1/2 is meaningless, and I think the market is focused too much on that, frankly.
Now, you say 4 or 5%. I don't even know if that's in the plans. From what I remember looking at the dot plot, they're looking at it, even if they did start a hiking cycle, it would max out at around 3 or 3.5, and perhaps that's what the market is worried about. Even 3%, they see would be detrimental.
Yeah, but that's years. That's what, 3 years into the future, I think.
Right.
It's certainly not imminent. And the interesting thing, of course, is that every time they do this dot plan, the interest rate hikes move further and further and further into the future. So I don't think the market needs to be really concerned about interest rates anytime soon. I mean, the odds of the next president appointing a Paul Volcker to come in, it's so remote as to be not even worth thinking about, frankly. That's not the issue. That's not what the market should be focused on, in my view.
Yeah, and when you talk about forecasts for what the interest rates are going to be, it really depends on who you ask, right? Because if you look at this dot plot, the scatter plot with the different voting members of the committee, it's all over the place. Some of them see it moving up aggressively, others see us going negative. I mean, it really depends on who you ask.
It is all over the place, yeah. But I think the two important points from that. It is all over the place. But number one, even the more aggressive, conservative, whatever you want to call them, hawkish members of the Fed, as you just mentioned, are still projecting relatively benign interest rates, 3 years into the future. That's number one. And the second point to mention, as I just said, is that every time they do one of these things, they keep pushing their predictions and forecasts further out into the future. I think this is a bigger picture, a bigger subject, but I think the Fed has boxed itself into a corner. It's kept interest rates far too low for far too long, and now it's kind of waiting for perfect conditions to raise interest rates. And, the truth is that in the real world, you don't get you don't get perfect conditions. I mean, we're not creating enough jobs, so we won't raise them this time. The stock market fell, so we won't raise them now. Inflation's too low, so we won't raise them now. Oops, China's got a problem, so we won't raise them now. There's always going to be a problem.
Maybe that's
just sorry.
Oh, maybe that's the way they like it. There's always an excuse to not raise rates.
Well, absolutely, absolutely. No, I agree with that. This is a huge subject. We could probably spend 2 hours on and bore everybody. But I think the fundamental reason that the Fed doesn't want to raise interest rates is nothing to do with feeling sorry for mortgage owners or unemployed or anything else. It's because the servicing costs of the federal government debt are beginning to get excessive. And when the federal government is paying about 12% of its total revenue on servicing debt at a time when interest rates are at 70-year lows and more and more and more of the financing is done at the short end, where rates, of course, interest rates tend to be lower than at the long end, then we have a problem if we start to raise interest rates. Right now, the federal government is paying just a smidgen over 2% on all of its outstanding debt, and that includes 30-year bonds issued 29 years ago. Just a smidgen over 2%. Compare that with the 6.5% 25-year average that they've paid over the last 25 years. So you're looking at extremely low financing costs for the federal government. If those rates started to move up, if that average started to move up from 2% to 3 to 4, then you're looking at over 20% of the federal government's revenue being just on debt servicing. And that's unsustainable. So I think that's the real reason the rates are staying low, and they're going to have to stay low for a significant period of time.
Yeah, it's interesting you bring that up. Chairman Bernanke just published a book and is on a book tour. And, the entire time that he held that position, I remember him saying that, the monetary policy can't do everything. Fiscal policy has to come in. Of course, the Keynesians take that to mean, and Bernanke probably means, that the government has to spend to stoke demand. But in a sense, he's right, in the sense that the fiscal policy is what's really killing us here, is that they won't stop spending. So the Fed can't raise interest rates. Exactly what you just said.
Oh, no. I mean, he's right on that. In theory, he's right. Although, as I say, I suspect he means something a little bit different. I also feel it's a little disingenuous of both Bernanke and also of Greenspan, who, of course, was at the New Orleans conference last year, and I heard him speak. I also was lucky to have a private lunch with half a dozen people with him. But I think these people are far too defensive. And Greenspan actually said something interesting. He was talking about fiscal policy. He was talking about the government spending too much money. And he said, if the government's spending the money, we've simply got to accommodate them by providing the funds. Well, I don't agree with that. If that's true, you don't need an intelligent person to head the Fed. You just need someone to print the money when the government's spending. I'm exaggerating here a little bit, of course, but that's basically what he said. He said we had no choice. We had to expand the money supply because the federal government was increasing its spending.
That's very interesting, and we have that conference coming up again, so it's interesting you bring that up. But I'd be interested in hearing more about what he had to say. What was your impression of Alan Greenspan overall?
Oh gosh, I mean he's a exceptionally intelligent person, and even at the age he is now, I'm not quite sure what it is, upper 80s, isn't he? I think 87 or something. Remarkably sharp and quick, no question about that. Very sharp.
You mentioned defensive. Did you sense
too defensive? Yeah. Okay. I think they are. Bernanke is doing it as well as Greenspan. I mean, in the books he's written, in the speeches, in the interviews, I think the number one thing is trying to defend his record. In the case of Greenspan, he absolutely refuses to acknowledge that the Fed's easy money policy in any way had anything to do with creating the housing bubble. He talks about FHA regulations, about the Clinton Act, expanding mortgages to low-income areas and the redlining and all of that. All of that, of course, is absolutely true. But the Fed enabled the bubble. The Fed was the enabler. And again, you know, a lot of people have used the metaphor of drug addicts and so on. If no one is supplying drugs, you might have a serious problem with the patient. You might have a recession if the Fed didn't supply the money. But the Fed was still the entity that enabled the housing bubble to blow up. And you know, Bernanke has the same kind of defensive attitude about how they had to keep rates low. You know, if they hadn't done what they did in 2008, this would have meant the end of capitalism and the end of Western civilization. He said it was a bigger crisis in 1929. And I don't know that the Fed's record of predicting the economy, I'm being a little understated here. I don't know that the Fed's record of predicting the economy, Greenspan saying we weren't going to have a housing bubble, Bernanke saying that housing's a little bit overpriced, but it's not going to have any impact on the rest of the economy. I don't know that their record of prediction justifies us accepting at face value what they say about the need for trillions of dollars of bailout in 2008. I mean, I just don't believe it.
Yeah, not to mention the role that the bailouts or the anticipated bailouts had in just contributing to moral hazard, right? Even if everything he said is true, if the people behaving recklessly knew that they were going to get a bailout and that bailout was going to come via the Treasury and the Fed, that enough is a reason to point the finger at them, isn't it?
Well, absolutely, and that I think is perhaps more Greenspan than Bernanke, you know, the famous Greenspan put. No, absolutely. Moral hazard is one thing. And then, of course, the other thing that's happened with very easy money is, and this is a little bit difficult for people to grasp at first, but ultra-low interest rates tend to see money go to wealthy people first, and it tends to exaggerate or aggravate, I should say, the income and wealth inequality in the country. So we've heard a lot about inequality in the last few years after the crash and after the bailouts. But you look at what's happening to the money. The money is not going to the banks. The banks aren't lending it to small businesses. They're not lending it to people other than for housing. It can be very, very difficult for people to get loans, but that money is going to Wall Street, basically. And so you see huge increases in wealth of the upper 1 and 2 and 3%, but the bottom 50%, they see their net income on an inflation basis and their wealth on an inflation-adjusted basis actually significantly below what it was in 2007. So for the bottom 50%, there's been no recovery since 2007 at all. And that's a direct result of easy money policy, where the money is not getting into ordinary people and small business, but is staying on Wall Street.
That's right. It's pretty simple. It's the money is gushing out of the Fed, going to people who have access, and then benefiting people who have access to those types of investments, accredited investors, people who invest in these hedge funds, for example. Eventually, that money makes its way down to the common man. And the fact that I think maybe it's happening now, we see, for instance, the debates on the minimum wage, right? Minimum wage being implemented, Walmart starting to get hurt because of wage increases. The fact that the money is finally starting to get to the common person in a small fashion indicates to me that this cycle is coming to an end, I think, and that the party's over.
Completely. No, I agree with that completely. And you can look at other indicators like, the inventory to sales ratio. in the last few months has shot right up. That's normally a precursor of a weaker economy. I'm not going to say we're heading to a recession imminently. I'm not suggesting that, but I do think we're heading towards a much slower economy, and we may well see a recession next year.
Right,
and of course the danger is, as many people have pointed out, everyone from HSBC to the IMF and they're not, especially the IMF, they're not exactly paragons of moral virtue, but everyone's pointed out that with interest rates staying so low for so long, there's not a lot of firepower that the Fed has left if we head into a recession. As you know, and I'm sure everybody listening knows, in a normal, typical economic cycle, the economy starts to, quote, overheat. The Fed raises rates, and then they raise rates too much, and the economy slows, and we slip into a recession. But because the recession was typically, in a typical economic cycle, is caused by rising and higher interest rates, they have an obvious solution to get us out of a recession. They start lowering interest rates, and we get out of a recession. At this point, we can't lower interest rates. We can hardly lower interest rates anymore to get us out of a recession if a recession occurs. And this next recession, just like 2008, was not caused by high interest rates. It was not provoked by high interest rates. So it's much more difficult to get out of.
Right, at least not nominal interest rates anyway, which are very low. Adrian,
Correct.
Can we move to gold now? Because I think gold has been quite perplexing to a lot of people. It hasn't really moved much this year, and one might have thought that if the Fed backed away from raising rates in September, that gold would have reacted sharply, and it didn't. So is this the gold market buying into the idea that we're going to get a rate hiking cycle and it's going to start in December or early 2016?
Let me just disagree with a couple of things that you said. First of all, you say the gold did not react sharply. I think you said to the Fed. If you look at gold's move sharply down in July and August, and then we've moved from 1085 or something up to a current 1166, that's a reasonably good move for gold, one of the better moves that gold's had in the last 4 years. I think there's a real problem that gold, over the last 4 years has been exceptionally weak. But I'm sorry, I'm trying to pull a graph up as we talk.
I see the move that you're referring to, but was that before the September decision not to raise rates?
Well, it started with the severe correction in global stock markets, and I think that's what the major issue has been. The major issue has been that investors, particularly institutions, hedge funds, generalists, they haven't seen much need for gold in the last couple of years because the stock market's been doing so well. As soon as the stock market tumbled in July and August, in August I should say, gold recovered very, very nicely. Now that the stock market is sort of doing well, gold has pulled back a bit. That's not the only factor, of course, and everything's interconnected. But I feel very, very positive about gold right now, to be honest. If you look at what you mentioned, the Fed, I think the gold market, if you look over the last 12 months, gold is reacting less and less negatively each time the Fed says, we are going to raise interest rates soon, maybe in June, we're getting ready, maybe in September, but definitely before the end of the year. It's like the boy who cried wolf. I think the market is taking less and less notice of the Federal Reserve. I think the market also realizes that the first interest rate hike really won't have much of an impact on gold at all. If you look back over the last 20 years, every time the Fed has raised rates for the first time, it's had It's had very little effect on gold at all. And in each case, gold was actually up within a month. So the first hike rate really means nothing. And I think the gold market is beginning to ignore the Fed because they've heard this story so many times. Demand for gold continues to be strong. There was concern that the market crash we had in China and decline in manufacturing, the slower growth, I won't say the slower economy, but the slower rate of growth in China might have affected the gold purchasing. But the last couple of months of data out of China suggests that that's not the case at all, and physical buying in China remains quite strong. It's also going up in India, and of course we're heading into a very typically a good period for gold buying with Christmas and Hanukkah and the Indian wedding season and so on. So, that side of the equation looks very strong. I think on the negative side, the dollar, as long as the dollar remains strong, I don't think gold is really going to move meaningfully ahead. And so long as other markets remain strong, gold has a big tailwind. But the one major thing that has been negative for gold, frankly, has been sentiment. And the sentiment is beginning to change. If you go back to July, every sentiment indicator you looked at was at, record lows. You looked at the options indicator, all-time low, never been more bearish. You look at what's called the bullish consensus. And the bullish consensus for gold was, for the first time in its history, actually bearish. Because typically, if you have a 70 or 75% bullish consensus on gold, that's considered negative. Now, last month, 2 months ago, it was under 50%. So every indicator you looked at, commitment of traders reports, every indicator was negative. Now, in the last couple of months, you've seen high-profile hedge fund managers like Druckenmiller, who bought, $9 million worth of gold, and other hedge funds have started to buy. You look at the ETF inflows, and in the last couple of months, we're starting to see inflows into the ETFs again after 3 years of outflows. So I think the sentiment is starting to change, and that's a positive because so many people are short gold at the moment, short gold and short the gold stocks. And if you start to see, and even more people are on the sidelines waiting to see what happens. You see gold moves meaningfully over 1,200. Say, it gets to 1,230, 1,240, 1,250. I think you're going to start seeing people who are on the sidelines decide they better jump ahead before it's too late. I think we could have a meaningful rally in the next 4 or 5 months.
Adrian, at 1166, are you a buyer?
Yeah, we're a buyer here, but I'm more a buyer of the gold stocks, to be honest. At this level, we've been in our managed accounts. We've been much more heavily weighted towards gold, either physical or the ETFs, relative to the gold stocks than we normally are. And that was a correct play. That was a correct move, although, frankly, when gold's down as much as it is, there's nothing to brag about. You're still losing money. But right now, we're heading more towards the stocks than physical gold. I mean, you look at the XAU, which is the index of senior gold stocks, relative to bullion. Other than the last couple of months, we're at 20-year lows on that. If you look at any kind of metric of the gold stocks, price to cash flow, price to book value, price to ounces in the ground, etc., we're at 10, 20, 30-year lows on any valuation metric you look at. So I think the gold stocks are incredibly cheap. And if you see gold, again, if you see gold start to move up 1220, 1230, 1240, I think you're going to start seeing people kind of scramble for the gold stocks, for fear of missing out on them, frankly.
Do you like the gold index, Adrian, or are there any particular names you want to talk about?
No, I frankly don't like buying the index in gold because with gold companies, to be honest, you've got to be extremely selective. And if you buy the index, you're buying basically everything. I should say one thing, though, if I may, and this is an anomaly about any. It applies not just to gold producers, but it applies to any kind of commodity producer. The companies that objectively are the worst companies, namely, they have higher debt, they have higher cost mines, higher costs of production, those are precisely the companies that will have the most leverage in a very strong move up. So if I were to say I'm not a fan of American Barrick, if gold were to go to 2,000, Barrick could be one of the best performers. I want people to understand that. I personally prefer to buy the companies with better balance sheets and lower cost of production, which you know will survive the downturn, and in an upturn, they will, they will give us plenty of juice, but they won't necessarily be the best performers. I just want to make that clear. For investors who don't really want to bother with individual stocks, the best index, in my view, is the Sprott Gold Miners Index, which is SGDM, the symbol, Sam George, David Mary. And the reason I like that index rather than the other indices, the more traditional and popular indices, is that unlike the other indices, which are purely market capitalization weighted, the larger companies have the biggest weighting, SGDM has a series of criteria that they use, and so it's not purely, and it's all objective, it's all done automatically. It's still not as good, in my view, as picking your own stocks, but for people who want an index, that's, in my view, without doubt, the best index.
Okay, I want to turn our attention now to global markets. Let's begin with China. China, I guess the recent performance has been quite dismal after a huge run up. It's down now, still I think up about 40% on a one-year basis, but just down heavily from its high. What do you think about China?
Well, if you look at China and the economy before you look at the market, I tend to be quite sanguine on China, to be honest. You hear a lot of people, a lot of wailing and gnashing of teeth over the decline in the rate of growth in China, but people seem they don't seem to remember that the economy is still growing and still growing at a much better rate than pretty much any other economy in the world. I know there's a huge debate as to how much you can trust their statistics, and I know a lot of analysts are looking at other indicators more like electricity usage and airline flights and so on and so on. But any indicator you care to look at, or more importantly, if you just take a visit and look on the ground, it's pretty clear that China's economy is still growing. So, we don't need to get into the argument about whether you can trust their statistics. It's clear that it's still growing. The problem with I'm not a fan of the Chinese stock market, to be honest, because I just think, too many of the companies are too opaque, and too many of them have, especially the state-owned enterprises, they have political agendas as well as economic agendas. We much prefer to invest in Hong Kong, buy Hong Kong stocks that have exposure to China, to the mainland. So you're still exposed to the growth of the economy and the growing middle class, et cetera, but you have the here you have the protection, if you like, of of a market where the accounts and the books are much more straight, if you like. So we're investing a lot in Hong Kong, and in fact, I think Hong Kong is probably the best market in the world right now in terms of its valuations and its potential. The market's come down, of course, because of what's happened in China. But even if you look at companies that are not particularly exposed to China, they've come off a lot, and the valuations, in my view, are just very, very good. You look at a company like New World Development, which is one of the largest of the real estate developers, mostly commercial. So you're not concerned too much with the impact of the wealthy Chinese who have been buying residential properties in Hong Kong and shooting up the price, and you don't have to be concerned about, well, what happens, if those people can't get their money out anymore, or what happens if those people stop buying. This is mostly commercial. You're looking at a great company, a large company, trading at 10 times earnings with a 5% dividend yield, trading at less than half times book value. Those are good valuation metrics, and that's for one of the biggest companies. If you look at some smaller companies, I perhaps don't even need to mention names, but some of the smaller commercial property companies in Hong Kong are trading at 4 or 5 times earnings, and one we own is trading at less than 20% of book value. So if you buy something like that, you've got a pretty good margin of safety, a pretty good cushion. And I'm just talking now about the property developers. There's a lot of other companies, as you know, in Hong Kong, a lot of companies are sort of conglomerates. There's one called Asia Standard, which again is a property company, but also it manages hotels and has a travel agency. This is only yielding 3% only, but it's trading at 12% of book value. 12% of book value. And it's trading at 2 times earnings multiple. Now you say there has to be something wrong with that. Maybe it's got a lot of debt. Well, debt to assets is 28%. That's a very, very strong balance sheet for a property developer, right? So what's wrong with it? I think the only thing that's wrong with it is it yields 3%, and Hong Kong investors tend to like high dividends. So this is not seen as a particularly attractive investment for those people. But if you can buy, for Chinese investors, Hong Kong investors, but if you can buy a company with a clean balance sheet at only 12% of book value, you've got a pretty good margin of safety there, in my view. We're buying Hong Kong pretty aggressively right now.
Adrian.
And there's a whole range of companies we could mention. Toy manufacturers. Let's see if I can pull this up quickly. Sorry.
Adrian, can I jump in just before you get there? I'm just curious, how does that compare to the historical price to book for that company? Is this just a result of the recent pullback in China-related, like everything China? Or is that typical for these companies?
No, it's always traded at. That's an excellent question. It's always traded at a low price to book. Let me just see if I can. You're asking me questions I need to try and get precise. It's always traded at low price to book, but this is just an extreme. If we look at,
we can probably pull this up.
To 2007, for example, it was trading at 50% of book. If we go to 2010, it was trading at 25% of book. So it's always been low, but this is the lowest it has ever been.
Very interesting.
That was an excellent question to ask, by the way, because as you know, different markets around the world tend to trade on different kind of valuation metrics. So Hong Kong stocks typically have high dividends. So if you go back, 30 or 40 years in Hong Kong, 5 to 6% is an average dividend yield. Now, in the U.S., of course, it's a lot lower than that. You look at Germany or Switzerland, they tend to trade at very low multiples of book. And so if you see stocks trading a book or a little bit below book, you shouldn't assume that is necessarily cheap for that particular company in Germany or Switzerland. So different markets tend to have those different valuations. And you're right, you've always got to compare it with its own historical averages, yeah.
Okay, I like the strategy you're using there, and one strategy that people use to invest in China indirectly is to go to the commodity producers, right? So Australia, Canada, New Zealand. That strategy's kind of been crushed lately. Do you see those types of investments coming back anytime soon? I mean, you said if you're on the street, China looks like it's not suffering as bad as the stock market tends to indicate. Do you see those stocks coming back anytime soon?
Yes, but yes, but not necessarily soon. Again, if you're on the street, things are still growing in China, but I think the important thing from the commodities point of view is they're not growing as fast as they were. And so when you looked at 2009, 2010, 2011, and things were really booming with double-digit growth rates in China, a lot of the commodity producers started developing new mines in response to that. Now, of course, those mines, because of the time lag from development of a mine to production, a lot of mines came on this year and last year. So they came on after the Chinese demand had already started to slow down. So that was the real problem with the commodities. So you've got increased production at precisely the time when you have demand slowing down. So you've got to work through that excess production first before, I mean, unless China reverses and starts booming again dramatically, which I'm not expecting, you've got to work through that excess capacity first. And it varies commodity by commodity, frankly. So you look at things like iron ore, where there's essentially no shortage of iron ore in the world. It's just a matter of how much of it is being produced based on the price. You know, it could take us years before we work through the excess supply. If you look at copper, and the copper production did go up a lot in 2013, 14, and 15, copper production went up a lot. Last year we had the Oppoortunities mine in Mongolia, which was the first major mine in about 12 years, number 10 or 11 in the world. I think within 2, maybe 3 years, you'll see production start declining again. And that's because of 2 factors. That's because of the natural decline in the existing copper mines. Remember, copper mines tend to be big and they tend to be old. So the vast majority, over 50% of the copper production is in mines that are over 100 years old. And as you get older mines, you dig deeper, and typically you have more problems, so you have more interruptions, and we've seen that in the last several years. But also the grades start to get lower, and but mines start to deplete after a while. But more importantly than that, so we're looking, if nothing else changes, we're looking at about a 25% decline in copper production over the next 3 years, just from the natural depletion in existing mines. That's phenomenal. But on top of that, because of the long lag from development to production, you pretty much know right now what mines are likely to come on stream in the next 5 years. And the truth is that in copper, there are no major copper mines. Major now. There's no major copper mines that are on the drawing board to come on stream in the next 3, 4, 5 years. And so you combine those 2 factors, and the copper production side of the equation is going to start looking very, very attractive, over the next few years. Markets being anticipatory, they look ahead. The market's going to start focusing on that decline in production, I think, sometime in the next, 6 months. And so copper, I feel quite attracted to. So it really depends on which commodity you're talking about, to be honest.
Okay, so before we leave the topic of commodities, we have oil trading at 45. Where do you see it going in the next year or so?
Yeah, I'm not an oil specialist, to be honest. Well, you've heard me talk about a lot of different things, so I'm really not a specialist at all. I'm a generalist. But I think oil, my prediction is that oil is going to strengthen, but it's not going to go back to, 80 or 100 in the next couple of years. I think there's the Saudis and the Middle East is producing enough oil right now. So unless, and this this move of theirs to boost production and push the price down, which was intended to drive out a lot, particularly of the U.S. shale producers, it hasn't really worked. Because what's happened in the U.S., we didn't see much reduction in production for a little while, and then you started seeing production slow down. But the drilling itself, not exploration drilling, but development drilling, really didn't slow. They just continued to drill the wells and plug them. So when the price of oil recovers, all that oil is ready just to come onto the market. And so anytime the price moves up a bit, if the price moves up to 55, 60 and stays there, you'll just start seeing increased production coming out of the U.S. So unless the Saudis, unless the Arab world or the OPEC decides to significantly restrict production, I don't think you're going to see oil move back to 80 or 100 anytime soon. Having said that, a lot of the companies are really quite cheap. We're avoiding the exploration companies because, they need access to capital. And in this kind of environment, people don't particularly want to fund exploration companies in this kind of cycle. I think some of the best values are in the big integrated oil companies, frankly. Things like Royal Dutch. Particularly if you're a more conservative investor, Royal Dutch is yielding 6.8% right now, and that yield is covered by earnings. That's not to say they might not cut the dividend, but that's a pretty healthy dividend, and I think the odds are that they won't cut the dividend unless the price of oil slips back significantly further. So, I like some of the big integrated companies. I also like some of the what are called the larger independent E&P companies, exploration and production companies, like Devon, for example. Devon's trading under $45 today. It was $70 back in May. And that's before you had the big drop, So it's certainly cheap on a price basis, and it's a well managed company, so on and so forth. Good balance sheet, and good margins. So like most of the smaller producers, they need a better price to be able to produce free cash flow. There is no free cash flow at the moment, but I think if someone's got a multi-year horizon, you can start picking away at some of these things right now.
Okay.
But I like the big integrated companies for people who want dividends.
Very good, Adrian. Before I let you go, I want to talk about the New Orleans investment conference that's coming up October 28th. You're going to be featured speaker there. Can you give us a preview of what you're going to be discussing?
Oh, yeah. Well, I've got a speech. I'm going to talk a little bit about what we've talked about now, what the Fed's policy means for both the economy and also for different sectors of the market, as well as the slowdown in China, what that means for different sectors of the different asset classes. And then in my workshop, I'm going to actually recommend, I think it's 7, but I'm going to recommend my favorite global investments that I think are good for the year ahead. I do that every year at New Orleans.
Very good. My guest has been Adrian Day. Please visit his website at adriandayassetmanagement.com. You can find out about his services there, and he also links to the New Orleans Investment Conference, at which he will be speaking October 28th through the 31st. Adrian, thank you so much for joining me late on a Thursday night. I really appreciate it, and I hope we can do it again.
Oh, yeah, anytime. I enjoyed talking to you. Thank you.
Thank you. And don't forget to visit powerandmarket.com for insightful interviews with the world's leading experts in economics, finance, and investing, like Adrian Day. This is the Power and Market Report. Until next time, take care.